On the way up, in financial terms, we're looking at your working years. The assignment there is pretty simple. You're earning, you're investing, right? You're trying not to touch that money. You're delaying gratification. Those are kind of that discipline, those money pattern things that we try to talk about on a regular basis. Everything that you're doing is really designed around the accumulation phase. All right. And then retirement arrives. All right. So retirement, boom, peak of the mountain. Suddenly, no one cares about how much you saved yesterday or what you invested or what your returns were. Now the question comes from how do I live throughout all of this, right? What's the next phase? And that's where that fear comes in because we don't exactly know what retirement looks for any of us, especially in passive income years. We're beyond our peak earning years. Welcome to another episode of WealthWise Banking. I'm Jeremy Lee Huggins here with my co-host, Jason Sipple. Dude, what's been going on, man?
Sounds like we're on some late night sexy talk, my friend. I am doing phenomenal, fantastic. You know, when you say fantastic, your body actually hacks your mind. It is like walking around with confidence. So these are the things I think about, Jeremy, these random things. But I'm excited about this episode. This is inspired by some of the old timers, people in the industry 50 years, and tell me what they're seeing and what they're seeing with this, what's it called, the $124 trillion tidal wave that's coming, the wealth
with
transfer.
A T.
Yeah, with a T.
Trillion with a T.
With a T. So we're going to talk about, a lot of times, we're going to say something that's going to surprise you today. We're going to talk about today 654,000 winners. And what are they winners of? We're talking about our 401k millionaires, right? We're talking about the folks that keep doing what is responsible, what feels responsible, right? They're fully funding their retirement. They're saying when they're getting their house paid off, and then they're going to travel, then they're going to slow down, then they're going to enjoy life. They've had this target for so long. But what happens to these folks when they finally get to the finish line and they think everyone's going to be there to celebrate them, but all of a sudden when they're ready to use the money, instead of feeling confident with everything that's going on in life, the money starts feeling a little dangerous. It feels dangerous to use the money. So today's conversation is not about how to become wealthy. There's a formula for that. It's about why so many successful people reach retirement with plenty of money, but they still don't have permission to enjoy it. They never feel safe enough to enjoy it.
Yeah, this hits a little bit close to home, right? You know, talking about 401k millionaires and what it takes to get there. Those are massive achievements for sure. To be able to have that discipline to get your company match. I'm excited for this episode because I work with many 401k millionaires who, to your point, are approaching retirement and not quite sure whether it's enough, even though they have millions into a 401k. So let's get into it, Jason.
And then what we're saying, like, listen to what we just said in this opening to get to this point right now, a few minutes in. We're not saying that people aren't doing the right things, right? We're actually saying the exact opposite. Usually we're railing and saying, hey, Americans only saving 4.5%. Like, we're never going to get there doing that. It's proven. But we're saying that problem isn't people fail to save. The problem is no one is preparing them. Like, none of their financial advisors are preparing them. What happens when you accumulate this massive nest egg and we get there? So, you know, Jeremy, I really think the thing that surprised me when we were putting this together is that we're not spending any time attacking 401ks. We're not saying they're bad. We're defending them. You know, why is that? Why are we kind of defending them?
Because to get there, to have that 401k, to get to that position, you are at least preparing your future, right? You are thinking long term. I think that'd be the first thing. America has actually become a really, really good point of helping people accumulate retirement wealth through, like your opening. What made me think about it was the financial independence, retire early, right? The FIRE movement. When people are working hard, they're having good money patterns, that is worth celebrating. Those are proper achievements. And those years that people have been saving consistently, right? Investing every month to get there, that's hard work. It's taking advantage of opportunities that are there. It's staying disciplined. It's not panicking when the markets shift on you, right? For a lot of families, that strategy, it does work, Jason. It really does. But hundreds of thousands of Americans who are becoming 401k millionaires, like retirement millionaires, what they're doing is they're getting to a position where they are incredibly disciplined, but they didn't do anything wrong. They're just they might be climbing the wrong mountain, right? So
Yeah.
climbing that mountain, I think, is what when I look at it visually, it's are you on the right mountain? Like you're climbing. I'm glad that you're out climbing. I'm glad that you're out doing the things, but are you on the right mountain?
And 25 years ago, you decided to climb that mountain. You decided that that was the goal. And guess what you did? You were persistent. You were consistent. The days you didn't feel like going to work, you went, you did the work, you did the thing, you kept contributing. Right? We're going to talk about one of these examples. I talked to one of these examples last night. It was my last call of the night, Jeremy. At the end of the night, like 8 o'clock at night, I want to be eating dinner. And I'm talking to a 401k millionaire with multiple rental properties that is terrified. 30 years, the same company. He's not terrified. He's excited, but he kept telling me, Jason, I've tried this, it didn't work. I tried this, it didn't work. I tried this, it didn't work. I don't know how I'm going to come back down the mountain safely. That was his message to me last night. Like, what do I do? Jason, what do I do? I need someone to tell me how to come back down because I spent the last 30 years going up.
Oh, I mean, yeah, coming down is actually the hard part, right? I think actually the courage to climb is typically the thing that stops people from actually climbing. But once you climb, to your point, how do you get down?
How do you get down and how do you have more access, more control? How do you come down where you're not worried and scared that, oh my God, what's happening in the market? What's happening here? And so we want to talk about like, I spoke about this. I looked this up. This is an actual woman. Her name is Elisa Brown, right, Jeremy? And what I loved about this is she's so relatable. She's not we're not talking about Elon. She's not a tech billionaire. She's not some celebrity. She's someone, a regular builder, responsible American. Like what we look at when we look at ourselves in the mirror. She's a flight attendant. She stays disciplined. She pays herself first. She trusts the process. And eventually, like we're talking about, she put aside 9.7% every year. She got the match. She's putting in nearly 15% a year with the match. She becomes a retirement millionaire. And then again, like we're saying, who's teaching Elisa Brown what happens next, right? If she's someone that's making 100,000 a year and she becomes a retirement millionaire, a 401k millionaire, well, Jeremy, do the math. How long would it take her to eat that up over the lifetime? She retires at 65. It's not very long, right? It's not very long, and
Yeah,
there's a
there's
lot of other
different.
implications.
Yeah, you can implement, the 4% rule or 27, it's different strategies that to kind of come down to it. I think giving those dollars direction, purpose, understanding what it is that you want, is a lot harder conversation. I'm very proud that she actually was able to get there. I think it's worth achieving and recognizing those achievements. Like she did something hard. She got there, right? Even simply getting there, is momentous. She got to the top of the mountain. I think right now we're just trying to figure out, is it okay for her to spend? How does she spend? What does she have permission to do? Like, what is she going to spend the next 30 years doing, right? Retirement is only a phase of life. It's that passive income phase that you have, but it's just a stage of life. It's not your peak earning years. She did the hard work during her peak earning years. Now, to your point, how do you come down the mountain? How do we prepare for that? And it's a lot easier, I think, if you map things out while you're young to map out the strategy to come down the mountain. Every professional climber, that's what they do. They map the strategy to go up, but also down. And if your only destination is to reach the peak without understanding how you're going to climb down the mountain, well, you're only halfway through life. You only got half of it figured out.
And you took direction of someone saying, hey, this is how you get up the mountain. They weren't wrong. This is maybe how you get up the mountain, but they didn't tell you all the rules, is kind of what I'm feeling. I think that's where we're leading to. They
Yeah.
didn't tell you all the rules with what's going to happen. And we're not saying it's wrong. Again, we're celebrating this, but we want to make people aware that planning, money, it's holistic. It's not just one thing. You really have to understand that there's many tools, there's many things, and we're just going to talk about how can you have a little bit more control and a little bit more certainty with part of, like if you're someone that's going up the mountain right now, we can definitely help you have a different approach to come back down safer. If you're someone that's already there, there's multiple strategies to help you come down safely too, right? So
Yeah, when you're looking at the bottom of the mountain and you're looking at the top up there, right? You're typically asking yourself one question, which is, how do I get up there? In finances, we're looking at asking the question, how do I grow this? But in retirement, that's kind of a different question, and it's a completely different one that I think that we're going to explore here, right? It's how do I get up there? That's the strategy.
Yep.
In retirement, how do I come down from that mountain?
And when I think about this, I don't know why every time. I know you've probably heard this before, many of you builders out there, but I always think about Everest, right? Where do most people actually die? Do they die going up? No, like 20, like the majority of them die coming back down. They never make it down. Like all the frozen bodies up there, Jeremy, not to be too morbid, but they're all littered at the summit when people are trying to come back down. They made it to where they were going and they didn't know how to come back down. They didn't have enough food, they just didn't have the ability to come back down.
Yeah. So on the way up, right, in financial terms, we're looking at your working years. The assignment there is pretty simple. You're earning, you're investing, right? You're trying not to touch that money. You're delaying gratification. Those are kind of that discipline, those money pattern things that we try to talk about on a regular basis. Everything that you're doing is really designed around the accumulation phase. All right. And then retirement arrives. All right. So retirement, boom, peak of the mountain. Suddenly, no one cares about how much you saved yesterday or what you invested or what your returns were. Now the question comes from how do I live throughout all of this, right? What's the next phase? And that's where that fear comes in because we don't exactly know what retirement looks for any of us, especially in passive income years. We're beyond our peak earning years. Let's start thinking about that early. Let's think about that phase of life because life, the way I look at it is life is just a series of chapters, right? I've gone through these chapters. I went through the introduction. Now I'm in, the middle phases of my book, right? But I still have a long way to go till I get to the finale. It'd be really cool as an author of my life to know and design what that final chapter is going to look like.
Beautifully said. I mean, and I was laughing. Man, in my world, you're not even in you're still in the second quarter, bro, or you're not even in the second quarter. I think you're still in the first quarter of life. In my estimation, like I'm at halftime. I'm at the beginning of halftime. You're not even in the second quarter. So you got a long time to go just to give you some. And so what I'm talking about there, your 30s are the first quarter, 40s second quarter, 50s halftime, 60s third quarter, 70 to 75. That is kind of the end of this game that we're teaching. And of course, you're going to go on well past that. You're going to live to be 120, 130. Someone's going to live to be 150 that's listening right now. So again, it's really, how do you have more control and more certainty that no matter what happens, because life's happening way faster than we're evolving and changing, right, as people.
Yeah. And so I got up there. I'm a 401k millionaire. I've accumulated all this wealth, but I don't know how to spend it. I don't know how to come down the mountain. I don't know if enough's enough. I don't know what taxes are going to look like. Don't forget, it's in a 401k. I probably have required minimum distributions starting age 72, soon to be age 73. What does that do? Well, if I'm looking in retirement, now every vacation feels a little bit more expensive, right? Helping my kids can feel expensive. Buying that RV could feel expensive. Replacing the roof could feel expensive, right? Because I'm making decisions off this nest egg, the 401k, the million that I have there, maybe a million, 2 million, 3 million, whatever it is. You have a lifestyle that you're trying to maintain in your passive income years. And replacing these things over time doesn't come without consequence. It's an opportunity cost to it.
Exactly. And this is wild. For 25, 30 years, your investments, and congratulations, by the way. I didn't know that you were a 401k millionaire already, my brother. So, for 30 years, your investments only had one responsibility: grow, not overnight, over time. And then overnight, all of a sudden, you're asking them to provide you income, to create confidence, to handle the urgencies, the emergencies, the opportunities, to support your spouse, to leave an inheritance, to protect against taxes, to fund travel, to help grandchildren. Life doesn't slow down. It's a lot, right? I just said a lot. It's a lot of responsibility for the same dollar. It's a lot of responsibility for the same dollar.
Yeah, I've personally met families who've had like $2 million and then they still hesitate to go on vacation, which is crazy, right? You have families today, if you look at these numbers are wildly swinging, right? You have the average income and then the median income in the United States. Guess what? Both of them below $100,000, right? But then you have a family that has a $2 million nest egg sitting in a retirement account that is afraid to go on vacation. And it has nothing to do with whether or not they can afford it. It's just that every single withdrawal feels permanent. That's what we're talking about. That's the fear. That's where it comes from. And they start asking themselves, well, what if I need this money later? All right. Guess what? That's not a money problem. What is that, Jason? It's not a money problem.
It's a money pattern. It's a money pattern. It's actually a confidence. It's a confidence situation, but it is a pattern.
Hmm.
And you know what was sad when I was around a lot of our peers, Jeremy, is they were talking about exactly this. And there is studies by PhD economists showing, oh, well, yeah, actually, it's proven that you don't need as much money to live on after you retire because you become afraid to spend the money. So it's shown that the longer you're retired, the less money you spend on your lifestyle because you stay closer to home. Because why? You spend all this time growing and all of a sudden you're retracting because you're afraid. That, to me, that painted a super sad picture.
It is. Yeah. What are you going to do? Become a hermit at the same time your life is passing you by? I mean, to your
That's
point.
literally the visual I got when these guys were
Yeah.
telling this, and they're telling it like it's factual stuff. And he's one of these very academics up there talking to us and saying this, and all I'm thinking about, my heart's breaking. I'm thinking about the hundreds of millions of retirees sitting there being, not the ones enjoying the villages, but the other ones that are just literally saying, well, hey, let's do less. Let's stay home. Let's just keep watching reruns. Let's just, have our life and be grateful we have the life because they don't feel secure.
And part of that insecurity, that lack of confidence, is those dollars have one job, right? At the end of the day, they go through this, and we mentioned this on previous webinars, that every single dollar needs multiple jobs. So, Jason, when we talk about that, let's just summarize it for a bit. Help me understand, or help our audience understand, what do we mean by every dollar needs a job? Ideally, more than one job.
Exactly. We want our jobs. So this is something that we're talking about when builders look at money. We don't see just one big pile of money. We see a team. We see actually our employees, and every one of our employees has a position.
Every dollar is an employee.
Yes, every dollar is an employee, and they all have names, they all have assignments, they all have something they're going to do. Some are designed for long-term growth, right? Some take on a little bit more risk. They're kind of the crazy dollars. They're going to go out there and see if they can get more dollars to come back and join them. Some are going to create income for us. Some are protecting the family. Some have the liquidity for the urgencies, emergencies, and opportunity, and some are the legacy piece. Some are what we're leaving behind for those that we love and the things that we care about. And again, what we're saying is the mistake that most people make, and unfortunately, probably the guy I was talking to last night, the folks with $2 million afraid to go on the vacation you were talking to, Jeremy, is that we're asking the dollars to do the same job. And then all of a sudden, when they're expected to do all these other jobs, like they don't know how to play the other positions.
Yeah, it wasn't coordinated. And some of them were just single unit jobs, right? And that's why you start seeing people treat every single account the exact same. Every account to them is just a pile of cash. It's not looking at the system. It's not looking at the strategy that built it all. If you imagine, you gave a football analogy earlier, but like if you imagine your quarterback also playing the offensive line while the quarterback then turns around and kicks the field goal as well as catches the pass, right? And then, hey, by the way, you got to go play defense. You got to play defense. Nobody's going to run a team that way. Maybe in Pop Warner.
Jeremy, I can't even right now. This is making me laugh. I'm just thinking about like our high school. I was thinking about our punter. Like I can't imagine our punter playing quarterback. And I remember being one of the linemen when our quarterback started to get a little bit, his head started getting a little big. I remember looking over the tackle and say, okay, let's give him a lookout block on this one. Right? And just making sure he remembers who's blocking for him and how he's going to eat crow if he doesn't do his job. Right. So like everything has its own assignment. I mean, I just went down memory lane for a second, but you don't build a football team by giving the wrong players the wrong jobs and expecting one player to play every position.
Yeah. Look at it this way. Your dollars have different faces on them, right? There's different presidents. Don't look at them all as a giant pile of greenbacks. I would look at them as different members of your team.
I like this. I really like this analogy. This is a lot of fun. So I hope you guys are enjoying this as well. Like look at your Ben Franklin is not going to have the same job as your George Washington is what Jeremy's saying.
That's it. Not at all, right? Your investments have one important job. Your business can have a job, right? Your cash, liquid cash has a job. Retirement accounts have a job. What's nice is that there are asset classes, reservoirs that can go out there and have multiple jobs, right? Where the dollar could have multiple jobs. And we talk about this a lot. It's for the 401k millionaire that's out there and just looking at, hey, this 401k has one job, and I get very scared. It's wealth preservation I'm afraid of. What you're looking at is the reservoir. What you're not looking at, you're looking at the dollars, but really you're not looking at the dollars yourself. You're actually looking at the 401k accounts. That 401k was only designed for one job. So you only see it as one job. That's what it is.
And then the question for everyone listening is, does every job in your current financial life have a clear purpose? Like one clear purpose? Or are you expecting, like Jeremy just said, are you expecting one account to solve every future need? Because builders don't collect products, right? They build systems.
Yeah, systems. It's all about the system. And all your pieces and parts need to be interconnected into what? A system at the end of the day. How do they work together?
Systems. I think I'm thinking, I'm feeling another T-shirt somewhere in here. So, so Jeremy, if every dollar shouldn't have the same job, then what job is missed from most retirement plans? That's really where this starts getting interesting.
Yeah, so the missing piece really isn't about earning higher rates of return. I think that that's what we want to think about, right? We're trying to get the highest rate of return. I immediately, flip that script over, and I'm like, if I got more money back just through proper tax strategy without having to put my dollar to risk, did I not just get a 20, 30, 40% return on my money without deploying it, right? If I'm looking at just implementing simple tax strategy where I'm keeping more of what I make versus taking a dollar and trying to earn 10, 12%, well, keeping more is a lot better than trying to take a dollar to earn a higher rate of return. It's a source of confidence at the end of the day. It allows you to enjoy your life without feeling like every single decision has to depend on a market, right? If all we're doing, we're afraid of the market. And that's the other problem with the 401k millionaire is your money's tied up in a market, whether, depending on what you have, is self-directed, right? But it could be in equities, it could be in real estate or cryptocurrency. Regardless, if it's in a 401k, it's likely in some sort of market, meaning it's exposed to risk at a time when you're in your passive income years, thinking that it only has one job, which is to support your lifestyle. We've talked about growth, though, Jason. We've talked about access. We've talked about liquidity. We've talked about assigning every single dollar to the same job. But during the webinar and stuff that you've done, you said something that really stuck with me before, and it was confidence, right? You said that we want to give more than just responsibility. What we want to do is confidence at the end of the day. And you said that a little bit earlier. I want to know. Let's dig into that a little bit. Like, what do you mean by that? When one portion of your wealth should have more than just responsibility, that portion of your wealth should also have confidence. Let's discuss that for a moment.
Yeah, exactly. Like we want to know that when life happens, that one thing I always ask Jeremy, here, just let's start off the right way. Jeremy, there's one guarantee in life. What is it?
Change.
Change. Your water heater goes out. Happened to us a couple of years ago, right before Christmas. Should you have to wonder, is today a good day to sell my investments, to liquidate some equities? If your son, your daughter calls up and he's buying their first home, should you have to depend on how did the market do? And if your grandkids want to go on a family vacation, let's everyone go on a cruise to Alaska. Should we wait to see what the president's going to say, to see how the market's going to do, or what CNBC is going to say before saying yes? That's what I mean by confidence. We want to know that whatever we decide to do in life, it's not tied to some external force.
Mm-hmm. Oh, you mean do we have control of our money or someone else?
Very, very simple. We are pretty simple dudes, Jeremy. I know we talk a lot. We talk a lot about these different strategies, but at the end of the day, the strategies that we're employing are very elegant. They're like your little black dress analogy you always give me.
That's my favorite. Yeah. That, for those of you who don't know, my life philosophy is summed up in the little black dress. Everything that you do needs to be simple and elegant. It needs to apply to multiple situations, like a little black dress. A woman can wear a little black dress to an evening party, to a tea, to a luncheon. She can wear it to a funeral. Like there's multiple places that she can take that little black dress. Life needs to be simple, it needs to be elegant, and it needs to be applicable in multiple locations.
And I love how excited you get about that little black dress. So let's, If
I
anyone
love
out
a
there is
woman
wearing
in
a
a little
little,
black dress.
if anyone out there is listening wearing a little black dress, just reach out to Jeremy, let him know. And on top of that, let's just hope to God we never see Jeremy in a little black dress.
Yeah, dudes in little black dresses, don't feel free. You don't have to, there's no
Don't,
reaching out. You can stay, don't contact me.
yeah, don't. So we're talking like to get back on track. We're just talking about a different way at looking at your retirement, a different way of looking at the jobs, right? This is builders understand that something that borrowers rarely think about. And borrowers, you have an opportunity to become builders, by the way, right? We're not ostracizing you off the island. You weren't kicked off the island forever. We're just saying that mindset, that shift, because sometimes the greatest return isn't another percentage point. It isn't going and say, oh, well, that one earns 10. Well, hey, this one earns 12. This one earns 13. No, it's sometimes just knowing that your family has options.
Yeah, your family should have options. And additionally, your confidence also doesn't necessarily replace growth, right? Your confidence should be there to protect your family and the growth that you've already created. Like that's what we're kind of looking at. So when we're looking at this builder framework, Jason, and we're looking at how you've implemented infinite banking, a lot of folks, and let's step back for a moment, they'll say that, hey, infinite banking is a terrible investment. What do we have to say about that?
Well, number one, I saw a couple of my peers that make really great videos on this. It's it's not an investment. It's not an investment. It's not an investment. It's not an investment. So you're right. It is a terrible investment. You are right. It's not an investment. It's a terrible investment.
Yeah. So
How's
we've
that?
waited this long before introducing the concept, right? Why is it when we're looking at implementing high cash value life insurance as a product, right? Because we do want to start with the product. Why is it, Jason, that a lot of folks will start comparing it to investments, to include the 401k?
Because their brains are trained to have their money do one job. They want the number one receiver, the wideout that runs a 4.3 40 that can go long every play and, catch some of, they want the Randy Moss. They want the guy who's going to make incredible catches. He's going to score touchdowns and he's going to drop some balls. He's going to get kicked out of games. You don't know what Randy Moss is going to do. You don't know which Randy Moss is showing up, but you want Randy Moss to be that go-to every single time, running long, gone down, and that's how you think everything and every single thing should be doing what Randy Moss is doing on a football field. How's that? Is that a pretty clear depiction of what we're talking about?
Yeah, you're basically saying that everything you're looking at, or people who are looking at it as an investment are thinking that this is supposed to replace their 401k or those retirement accounts, to replace those growth accounts because they're trained to think in terms of chasing higher returns. What we're saying is this is really about architecture. So I want to help our members and our audience understand that this is part of an architecture where we're maintaining liquidity access, right? We're creating really a family banking system, so to speak. I like to think of the policies, honestly, Jason, as a personal line of credit. That's how I look at it. So when we're looking at what does the family actually need, and we're not talking about just financially, like we're looking additionally, emotionally, practically, relationally, right? Where are they today? I see you raising your hand. Go ahead.
Yeah, I'm raising my hand because I'm thinking when you said they're a personal line of credit, I want to say, and they're a personal line of credit. When you use that line of credit, you never interrupt the compounding. When I heard my peers talking about this over the week, people in this industry, 30, 40, 50 years, we kept describing all of the incredible things, what we're sharing with you, what it does. And then you hear the name and you're like, horrible, terrible. Daddy Dave says it's the wrong thing. It's the wrong player. Throw a penalty flag. It's been around for hundreds of years, folks. Why do you let other people train your brain when you hear what it can do? Like Jeremy said, it's a personal line of credit. And you never interrupt the compounding when you use the money. And you probably earn a dividend on that money. And it's protecting your family. I can go on. You want me to go on? No, Jeremy, back to you.
Yeah, I mean, at the end of the day, it's just a different reservoir, right? It's
Yeah.
not your 401k, it's not your IRAs, it's not your growth accounts, it's not an investment. It's a different reservoir that allows your Ben Franklins and your Washingtons to perform different jobs inside of it. That's what we're looking at. Your retirement accounts could be doing really, really well one year, right? Your investments could be doing well. When I look at this as a hedge, basically against market risk, in my passive income years, this is where I would go. Why? Because I know that there's going to be growth in the policy. That's guaranteed, right? And I'm based on the carriers that you and I like to use. They've been doing it for over 120 years, giving out those dividends. What I don't want to do is have a 401k, let's say at age 65 or 68 in passive income, and have a 401k with a market correction or heaven forbid, a market crash. Because that means that I have to now sell more shares at a discount to maintain the same standard of living when I was already afraid of going on vacation. Remember? Now I'm actually concerned about my cost of living. I could use my policy as a personal line of credit to end up covering the gap. That way, when the market recovers, I'm capturing that gain. I'm capturing that progress. When the market recovers, I put the money back into the policy like a personal line of credit. At the same time, the cash value continued growing. I just simply leveraged the death benefit for a short period of time. That's all I did. I used it where if something did, for heaven forbid, happen to me, the death benefit's reduced by the outstanding money that I pulled out of the policy. That's how that uninterrupted compounding happens. If you're asking like, hey, how's the mechanics going? That's what we're getting. We have leverage inside of the policy. The insurance carrier was already planning to pay a death benefit. I'm just the way, in very simple terms, this is not the actual mechanics, but in simple terms of thinking about it, I'm getting access to that death benefit while I'm alive. That's the living capital piece behind it.
Yeah, you're leveraging what your cash value is collateralizing, borrowing against. There's a lot of different ways to describe it, but at the end of the day, you're the one that's in control. But that's another reason we love it. Jeremy and I love control and guarantees. Maybe we're a little crazy. If you don't love control and guarantees, probably not for you. But if you love control and guarantees, this is something that we can show you how we've implemented in our systems, how we've gone ahead and not only do we still put money into things that can grow faster, that can be investments for us to make us a bigger spread, but at the same time, we maintain liquidity, we maintain control, we have legacy, we have structure, we have systems. We're not giving all the dollars the same job because we're intentionally creating a system. And if you want to learn more, like if you're one of the 401k millionaires and you're thinking, oh my God, how do I come down the mountain? Then go to wealthwisebanking.com and schedule that call with us. Let us have a strategy meeting with you and see what you really want to accomplish, because we will never give you any direction without fully understanding what you're trying to achieve.
Yeah, everything needs to be meaningful and manageable at the end of the day, right? I want you to continue putting money into your growth assets. I want you to continue thinking long range. I want you to continue to keep those same patterns. What we're doing is we're creating something, a different reservoir, where if you look at previous episodes, this is also how we're helping to plan generation 2, 3, and 4, passing on generational wealth while maintaining access and liquidity today. So if that interests you, if you want to see how it fits into your structure, how to come down the mountain, again, go to wealthwisebanking.com. We just simply look at where you are today with who you want to become long term.
And what a beautiful way to wrap this up. You know that you're already in banking.
You're just not the banker yet. So go to wealthwisebanking.com, start the process.
See you next week.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.